Hi, my name is Jonathan Lopez, president of Golden 15, where we're a company dedicated to teaching the investment principles of Benjamin Graham. And for more information, you can look at www.goldenxv.com. Okay, so we want to start out teaching the principles of Benjamin Graham. So who was Benjamin Graham? Benjamin Graham was the father of value investing. He was also the teacher and mentor of Warren Buffett. He wrote two seminal books on investing. One was called The Intelligent Investor, which Warren Buffett called by far the best book on investing ever written. He wrote another book called Security Analysis, which really became the textbook for the investment industry. And so we want to teach you his philosophy of investing. Now let's start out with his definition of what is an investment. And here's what he says. An investment operation is one which upon thorough analysis promises safety of principal and an adequate return. Okay, now so there's three components to that definition. Number one is thorough analysis. Number two is safety of principal. And number three is an adequate return. Now it's amazing that we're talking about investing in stocks, and one of the main components of his definition is safety of principal. Is it possible to get safety of principal by investing in stocks? Well, Graham says yes, and here's how I want to explain how he shows that you can do that. Well, number one, we start out with thorough analysis. Here's how he defines thorough analysis: the study of the facts in light of established standards of safety and value. So if we're going to learn established standards of safety and value, and it's going to be much like the way a bank would look at a potential borrower. Now, what is a bank looking for when it's going to lend out money? Well, it's looking for two things. Number one, they want to make sure they're going to get their money back. And number two, they're going to want to make sure that they're going to get an adequate return. Basically, they're looking for safety of principal and an adequate return. So they do their thorough analysis. And basically, they look at three things. They look at the borrower's income, their assets, and their credit. And we're going to look at those same three things. We look at their income. For example, the bank would ask, well, do you have an income? Is it steady? Is it sustainable? Why? Because I want to know if I'm going to get my money back. The second thing he says is, well, what kind of assets do you have to back up this loan? He's going to do a mortgage. He's going to want to make sure that we're going to secure that house, and we want to make sure there's enough equity in it. So why? In case whatever goes wrong with your income, we can always come back for those assets so that we get what? Our money back with an adequate return. And then the third thing they're going to ask is, well, let me see your credit. Because they want individuals with good credit that show a propensity that they will pay you back your principal and your adequate return. So when we look at a company, we're going to look at those three things as well. We're going to look at the company's income. We're going to look at their income statement. We're going to look at their assets. We're going to look at their balance sheet. And we're going to look at their credit. Okay? And that's our thorough analysis. The second point is thorough analysis, safety of principal. Safety of principal, he says, protection against loss under all normal or reasonably likely conditions or variations. Now the fact is that the stock market is volatile. But over time, we should be able to have safety of principal under all normal or reasonably likely conditions or variations. And no matter how good we do our thorough analysis, there's going to be some things that no amount of thorough analysis would ever uncover. For example, BP. BP had that big oil spill in the Gulf. Their stock went down from about 60 to 30 over a short period of time because of that. That would be something that no matter, you would not find in their income statement or their balance sheet or looking at their credit. So aside from that type of an event, we should be able to have a reasonable safety of principal if we follow established standards of safety and value. Okay, so we're going to get our safety of principal by three things. By buying good quality companies, number one. Number two, by paying a reasonable price for those. Or in other words, value. We don't want to pay too much for these good quality companies. If we could buy them at a reasonable price, or even better, if we could buy them at a discount, that's going to give us a margin of safety or safety of principal. And number three, diversification. What Graham says is we should diversify across at least 10 to 30 companies. So it's amazing that there is some diversification, but it doesn't have to be a huge amount. So if we buy good quality companies, buy them at a reasonably priced, and we have a diversified portfolio, we should have safety of principal. And the third thing is an adequate return. And he defines adequate return as any rate or amount of return, however low, which the investor is willing to accept, provided he acts with reasonable intelligence. Okay, so if you expect to swing for the fences, become a billionaire overnight, this is not the investment methodology for you. This is for someone who's looking for solid, steady growth over time. Warren Buffett became a billionaire, not overnight, over a course of many, many years of investing this way. Okay, and so we should be able to expect to get market-like returns or better if we act with reasonable intelligence. So that concludes Benjamin Graham's definition of an investment. Next, we're going to look at specifically what does he mean by quality blue chip companies.